Hey everyone, welcome back to Valareso Capital. On today's video, we're gonna cover one of my absolute favorite indicators, and that is the 21 exponential moving average. I did make a video before on the 21 exponential moving average on the channel, and that was actually one of my first videos in the channel. It's a really helpful video, and I'm gonna have the link in the description if you wanna check it out. In this video, we're gonna cover more examples, and we're gonna use the TradingView replay system so that we can actually take a look at the price action. This is one of the videos from a series of videos about my trading tools. So if you haven't watched the first video of this series, make sure to watch it. It is about the 8th exponential moving average, and that link is also going to be in the description, and you should see the link also popping out in this video right now. So the purpose of these videos, for anyone who's new to the channel or just checking out, the purpose of these videos is to actually go through my entire trading system. So we're going to cover a lot of things, including the 8 exponential with something that we already covered, the 21 exponential, 50 daily moving average, 30 daily, 200 daily, and we're going to go through all my indicators, and you can see all the names in the slide that is right now in the screen. So we're gonna go through all of that, and this video today is about the 21 exponential. So get your notebook out, because it's gonna be a note-taking day. So we can just start here in the let me just grab my thing so that we can start with the video. And the first thing that I wanna cover is what is the primary purpose of the 21 exponential moving average. And the primary purpose of the 21 exponential moving average is actually to identify the path of least resistance for the stock that I'm gonna be trading. So that's gonna be the primary purpose of the 21 exponential moving average, and one of the reasons that you should have the 21 exponential moving average on your charts. Now, the 21 exponential moving average is a significant indicator of the momentum in either direction of the stock. So it depends if the stock is trading above the 21 or is trading below the 21 exponential. If it's trading above the 21 exponential, then we expect a lot of momentum trading to the upside. And if the stock is below the 21 exponential, then we're expecting a lot of momentum to the downside. And usually what happens is when the price breaks significantly, either to the upside or to the downside of the 21 exponential moving average, we're expecting for the rally or the decline to be over, or at least the momentum to decrease in the rally or the decline. So that's actually a pretty important thing. And the first example that we're going to cover is going to be on Google. So as you can see here, I have Google right here on my charts. And what we're going to cover in Google is actually we're going to see what the interaction between the price and that 21 exponential moving average actually is. So let me just grab some of my tools here, and let's just hit play so that we can actually see what the interaction between the 21 exponential moving average and Google is. So you can see right here, when Google is trading below this 21 exponential moving average, right, you can see that the price actually tend to came below it. However, as soon as Google, let me just pause the video here. As soon as Google starts to break above it, right, you can see that right now Google starts to break above this 21 exponential. You can see that the path of this resistance, as we mentioned, starts to be to the upside. So that's actually a pretty important distinction that we have to make. So let me just hit play again so that we can actually watch the entire thing. And this was actually a pretty sustained rally that we had in Google in 2021. So you can see right here that we find support at 21 exponential, and you can see that the price just continued to trade to the upside. You can see that the 21 exponential help as a floor to sustain the price action, and we actually came here just a couple of times. And this is actually a pretty important thing right here that is happening right now. You can see, and let me just pause it right now, you can see right here that as price continues to find support at the 21 exponential moving average, you can see that we were starting actually to form a little bit of a base, something that we're going to cover in this video as well. But you can see that this 21 exponential moving average helped as support, and then it continued to help the price move to the upside. So that's actually something really, really important. You can see that right now Google is just rallying. You can see that here we have our first pullback to the 21 exponential moving average, and this is actually pretty important because you can see that price went above it, but then price came right back to that 21 exponential moving average. You can see that buyers were really aggressive and they closed the price right above the 21 exponential moving average. That's actually a pretty important thing to notice when you're trading, right? Because we're trading every single day, especially if you're a swing trader like myself. We're looking for price to find support at these very important levels. So you can see that here buyers step in, and you can see that the next day buyers step in back again at that 21 exponential moving average, and then we had a very explosive continuation of the trend. So it's actually pretty important to notice. And then you can see that Google continued to trade to the upside. You can see that we're starting to get a little bit extended here with these candles, but the 21 exponential moving average continues to trend to the upside, and is basically telling us, hey, this trend continues to be a really strong trend to the upside. So you can see Google here is coming back again at the 21 exponential moving average, and this is working just like magic, right? You can see that Google extended, then it traded a little bit sideways, waited for that 21 exponential moving average to catch up with price, found support at the 21 exponential, and then just continue to trade to the upside. And you can find this basically in everything that you're trading, whether it's Bitcoin, Ethereum, you're trading oil, gold. That 21 exponential moving average is going to work just as fine. And also it's going to work in all time frames. So this time frame in particular is the daily time frame that we're watching, right? But you can use the 21 exponential moving average basically in all your time frames that you're trading. So once again, Google coming back right to that 21 exponential moving average back again. But now notice what is happening. This is actually pretty important to notice, right? You can see that price extended, then came to that 21 exponential moving average, held, but you can see that the bounce wasn't as strong. And this is something really important. This candle right here is very important, because this candle, right, you can see that in the past we tested it once and bounced, but this time we tested it, we bounced, but then came back to that 21 exponential moving average and up breaking. So that's a huge red flag, and that's something that we mentioned, that when the price breaks that 21 exponential moving average, that sustained rally tends to come to an end, and then you can see that the price gap below the 21 exponential moving average, and now we're rallying back to that 21 exponential. So let's see what happens next here in Google. You can see that Google got rejected. So this is actually pretty amazing, right? You can see that we got rejected. We rally back to the 21 exponential moving average, found resistance, and then we continue to move to the downside. So that's actually pretty interesting, and that's one of the examples that we are going to share in this video. Now let's continue moving forward here. So what makes the 21 exponential moving average and something that you want to put on your charts? First of all, the 21 exponential moving average, we're talking about exponential, is different from the SMA, which is the simple moving average. The 21 exponential moving average is more sensitive to the price action, given that the weighting that it's giving comes from a different formula. Basically, we're talking about the exponential smoothing factor. So here in the charts, let's take a look at the formula. You can see that the formula for the exponential smoothing factor is actually 2 over x plus 1. And x is going to be the number of periods of the moving average. In this case, that we're calculating the 21 exponential moving average, then that x is going to be 21. When we actually go through the calculation, you can see that we get the result of 0.0909. And that basically comes into a percentage. So we multiply it by 100 so that we can get the percentage. And we actually see that the weight that the 21 exponential moving average gives a weight of 9.090% more to the most recent price action. So we're talking about the most recent day is going to have more of a weight in the price, and then the remaining weight is just going to be distributed equally for the last 20 periods. So this means that we're going to get a more responsive moving average. And that's actually one of the reasons why I think the 21 exponential moving average is actually one of the most important moving averages that you're going to have on your charts. Now let's continue moving here. And some of the questions that I ask is actually, what is the most effective way to use the 21 exponential moving average? And in my experience, the most effective way to use the 21 exponential moving average is to use the 21 exponential moving average as a compass for the path of least resistance, something that we already mentioned. But why do I mean by this? What it means is that you are only going to look for bearish positions when the price is below it, and you're only going to look for bullish positions when the price is above it. And it doesn't matter what time frame you're trading. You just have to understand that if you're trading a lower time frame, then the movements are going to be a little bit faster, right? So let's take a look at another example here in Mara. And this is actually a pretty amazing example. So let's take a look at here at Mara. You can see before I hit play here, you can see that Mara was trading above this 21 exponential moving average. You can see that it found support here, we continue to move forward, but then you can see that it break, right? And here is once again the same pattern. We came to the 21 exponential, we bounced, but then the next day we broke it. And that's a huge red flag, and that is when the 21 exponential moving average started acted as resistance. So let me just hit play here so that we can take a look at what Mara is doing. And you can see that Mara broke the 21 exponential moving average, moved to the downside, tried to move above it, got rejected, and now we're moving to the downside, right? So that is the path of least resistance, and that's how we're going to use it. Now, this is actually pretty interesting. The price came, broke above the 21 exponential moving average, but if we compare it to the time when it did it here we move above it, but then we lose it the next day. In comparison, here we move above it, but now we continue to held above the 21 exponential moving average for 3 days more. So that's basically telling us that this 21 exponential moving average is actually going to start to move to the upside. So now we're getting more traction, and you can see that price is basically going parabolic above this 21 exponential moving average. So now we're using the 21 exponential moving average as a compass, meaning that when price is above it, we're just going to be looking to trade to the upside in the direction of the trend. So let's continue to look a little bit of the price action here, and you can see that Mara make a really nice flag here, continue to move to the upside. And the 21 exponential moving average basically just continues. You can see that price got really parabolic, and this is very important. So let me pause the video here. You can see that Mara got really parabolic, but look at this candle right here. This candle breaks considerably below that 21 exponential moving average, and now we have 2 daily closes, basically 3 daily closes below that 21 exponential moving average, which basically just increases the probability that the trend is gonna change, and that this 21 exponential moving average is now gonna act as a level of resistance, indicating more downside in the stock. And this is basically exactly what happens. You can see right here, price try to came into that 21 exponential. We're getting rejected here, getting rejected back again, and now price is just getting really strong to the downside. And this is actually pretty easy, right? It's just like, wow, if I just follow the 21 exponential moving average, I can make things really more easier for myself. So it's actually pretty interesting. And then you can see that Mara got rejected back here again, and it just continues to move to the downside. So that's actually one of the most effective ways, and actually one of the most easiest ways to use the 21 exponential moving average. Just use the 21 exponential moving average as basically like a line in the sand, and tell yourself, I'm just going to trade bullish positions when the price is above it, and I'm just going to trade bearish positions when the price is below it. Now, if we continue moving forward here, what is actually something very important is that if you combine the 21 exponential moving average with price structure, then it can turn into a really high probability level for entering a position before a trend starts. So we're gonna cover an example here in SQ. And what I want you to notice is what is the interaction between the price and the 21 exponential moving average before breaking through the base that we're gonna take a look at. So let me just hit play here in Square, and you can see the price is going above this 21 exponential moving average. So this is what I want you to take a look at. You can see that Square, and let me just grab a different tool here. You can see that Square, right, came here, corrected, and if you know anything about chart patterns, you start to see that this is actually forming a double bottom. for the look of a square, you can see that we're starting to get a little bit of a base here, a little bit of a resistance level, and we're also getting a little bit of a resistance level up here. So let me just hit play again here. Let's take a look at what happens. You can see that a square came up, and now we came all the way below it. We actually broke that double bottom. We continue to trade below it. So we actually failed there. But here's the interesting part. So here is the interesting part, right? So we actually, if we go back, right, if we look in kind of in hindsight, this looked like a double bottom. We actually broke above it. But what is interesting is that the 21 exponential price closed 2 times above the 21 exponential moving average. And if you build your position as close to the 21 exponential moving average, then you have a little bit of profit, and you're probably going to set your stop here. You get a stop to the downside, and this continues to trade to the downside. But as patterns tend to repeat themselves, we can see that price is doing kind of the same thing back again, right? So here, if we take a look here, right, you can see that the price broke below this low, but we are actually just basically price is just continue to form the base. So what is the point? What I'm trying to illustrate here is that when price is basing, right here price is basing. If you want to trade this base to the upside, then you're most likely not going to buy your position as long as the price continues to trade below the 21 exponential. So if you decide to build your position only above this 21 exponential moving average, then you have a higher probability of continuation. So of course, if you decide, let's say that you decide to buy this day. You decide to buy this day, you wouldn't be in a stop out here, and that's fine. If you decided to build your position this day, you would be the stop out here, and that's fine, right? You're risking low, you're risking a small amount of the position to catch an upcoming trend, right? But look at here. If you decide to build your position here, once again, then look at what happens, right? This is actually pretty interesting and pretty important. You can see that square found support here, and now we're going, right? Now square is starting to go, and now you have a trend. Now you're catching a big winner, and you're catching that big winner above that 21 exponential moving average. So it's actually pretty important, and then we end up losing that 21, and that's the end of the trade. But this is my point here. My point is that most of the time when we are starting to form a base, when we're starting to form some price structure, some people wait for the breakout. So some people wait for this breakout right here to get into the position. But my point here is that why wait for this breakout when you can actually look to buy your position as soon as that 21 is reclaimed, is recovered. So that's my point here. So sometimes, yeah, if you buy it here, then you're probably going to set your stop somewhere around here, and you're going to be a stop out. If you buy it here, you're probably going to set your stop somewhere around here, and you're going to be a stop out. But the thing is that when you're right, when you actually build your position at the 21 exponential moving average, then you're putting yourself in a position to actually hold a really big winner and a really big trade. So that's something really important. Remember that when we are trading, we have to think in probabilities, and we're actually gonna make mistakes, or we're basically gonna have losing trades many times. However, when we actually catch a big winner using a rule as simple as this 21 exponential moving average, then we're putting ourselves in a position to catch a really big trade. So that's actually something really important. And then just guys, to finish this video off, let's just take a look at a complete example. I'm gonna go through AMAT. This was a very popular stock to trade in 2020 and 2021, and let's just take a look at the price action. I'm just gonna let it play so that you can actually spot the places and what the price action is actually doing. You can see that as we have the reclaim, remember the reclaim that we were talking about, now you're putting yourself into a big position instead of just waiting for the breakout. So here's the reclaim, price is starting to go parabolic. You basically build your position around the 21 exponential, so you're sitting on a huge winner here in AMAT. and you're seeing that price is just going, 21 continues to rise. And you might ask yourself, let's say that you missed that entry, that early entry in that 21 exponential, then you just have to wait, because most likely price is going to come right back into that 21 exponential at some point in time, and then you're going to be able to build your position at a low risk entry, and then you're probably just going to see more continuation of the trend. So now we're seeing a lot of continuation, AMAT going parabolic, going pretty nice, and you can see that the best entry was that 21 exponential moving average, and that's something that I love about this indicator. Now you can see that price is coming back here again. It actually flashed a lot of people here. Probably you wouldn't be in a stop out here. However, if you're looking closely at that 21 exponential, then you're like, okay, we reclaim it, we close a couple of times above it, let me just get in back again. And now you're holding another winning position here in AMAT, and this is just continues to go. Price is starting to get a little bit loose here, and now price is starting to lose that 21 exponential moving average, but then reclaiming it back again. And it's kind of a dance, right? You know, and of course, taking profits when we get extended from the 21 exponential moving average is going to help you actually holding or minimizing your losses or keeping the profits when price actually shakes a lot of people here. So you can see that AMAT continues to find support at that 21, continues to flow, and this is actually a pretty amazing position. And we can watch it for a while, right? So, but my point here is that 21 exponential moving average is actually a really important indicator. And once the price actually breaks that 21 exponential moving average, that's when we start to see some really strong changes in the trend. So now you can see that the price is actually breaking below this 21 exponential, and now we have a huge rejection, and now the trade is completely over. So that's gonna be it for the video, guys. I'm really sure that you found a lot of helpful information here. If you're a new trader, learning about the 21 exponential moving average early in your career is gonna set you, is gonna give you a huge edge. This is an amazing indicator. If you study it, if you understand what are the entry points, how does it work, what is the calculation, what is the psychology behind it, you're gonna put yourself in a winning position. So once again, thank you so much, guys, for watching. Remember to like and subscribe, and also follow me on my Twitter channel, in which I share a lot of the setups, and I also share a lot of the information that I share in these videos as well. And remember to set the bell icon so that you are notified when I get more of these videos about my trading edge in my YouTube channel. Next video is gonna be about the 30 daily moving average, and that's actually one of my most favorite moving averages, and is one that people doesn't use much. So we're gonna cover that on the next video. And until then, guys, take care, and I see you. Bye bye.